This podcast is for educational purposes only and is not financial advice.
Exactly right.
Welcome to the 15-Minute Investor. Today we're covering the massive structural shock to the global trade landscape that just hit the wires. We are talking about the Supreme Court striking down the vast majority of the administration's trade tariffs.
Yeah, it is a truly significant disruption. We aren't just looking at a legal opinion here. We are talking about a fundamental shift in fiscal projections, a massive capital injection into corporate balance sheets, and, well, a complete repricing of risk for importers.
Right. And before we really get into the weeds on this, links and resources are in the description below. If you find this podcast helpful, please consider subscribing to the channel for more market updates.
You'll definitely want to subscribe because this is going to be a developing story for a while.
Absolutely. So let's unpack this deep dive, because usually trade policy is this slow-moving glacier. You see it coming from miles away.
Oh, for sure. You get months of warnings.
Right. But this Supreme Court ruling hit the market like a lightning bolt. We've had these tariffs operating as just the background noise of the economy for over a year now.
They were totally priced in.
Completely priced in. And then suddenly, the gavel drops.
It certainly caught a lot of desk traders off guard this morning. I mean, the consensus was that the court might trim around the edges.
Maybe limit some future authority or something.
Exactly. But to strike down approximately 70% of the existing tariff framework, that is a demolition.
It really is. And it's a 6-3 ruling, too. It wasn't some razor-thin controversial margin.
No, it's decisive.
I was reading through the majority opinion, and what really stood out to me was the focus on the IEPA, the International Emergency Economic Powers Act.
That's the core of it.
The administration essentially used an act designed for freezing terrorist assets or sanctioning rogue states to rewrite global trade policy.
And that's the crux of the legal argument. The IEPA has been around for nearly half a century. It's a very powerful tool, but it has historical guardrails. The court's decision emphasized that no president has ever used it to impose tariffs of this magnitude. They argued there was just a total lack of historical precedence for a scope this wide.
Because usually, if you want to levy a tax, and let's be honest, a tariff is just a tax you have to go through Congress.
Yes, it requires a vote.
Yeah.
The Constitution is pretty clear on the power of the purse.
So the administration tried to bypass that by declaring a national emergency.
And the court didn't buy the emergency classification in this specific context?
They cited the drug crisis and the trade deficit for that emergency, right? I mean, obviously, those are very serious issues.
They are.
The argument was that the influx of illegal drugs was a massive public health crisis, and the persistent trade deficit was undermining critical supply chains.
Which are valid concerns.
Sure, but the court essentially said, yes, those are problems, but they don't give you a blank check to rewrite the tax code without the legislative branch.
It's a classic separation of powers issue. The ruling states that the authority the president claimed extends far beyond the legitimate reach of the act.
Makes sense.
But while the constitutional scholars are having a field day with the separation of powers right now, investors really need to pivot immediately to the cash flow implications.
Because the money moves fast.
Incredibly fast. This ruling triggers a chain reaction that moves a staggering amount of capital around.
Here's where it gets really interesting. For anyone holding retail stocks or just looking at the consumer discretionary sector in general, when I first saw the headline, tariffs struck down, my brain immediately went to, okay, goods get cheaper.
That is the logical first thought.
But then I looked at the mechanics of how these things are actually paid, and I realized we're looking at something much weirder. We're looking at a refund.
That is the multi-billion-dollar catalyst that I don't think the broader market has fully priced in yet. To understand the opportunity here, you really have to follow the money.
So walk us through the plumbing here. When these tariffs were active, the importer, let's say Walmart, Costco, Nike, or LVMH, they were the ones actually writing the check to the U.S. Treasury to get their goods off the boat.
Correct. The importer of record pays the tariff at the port.
But they didn't just eat that cost. I remember looking at CPI data and earnings calls from last year. Companies were very open about passing those costs on.
Extremely open.
Estimates suggest about 90% of the tariff cost was pushed downstream to the American consumer.
It was effectively a pass-through tax. You paid for it in the higher prices for your sneakers, your electronics, your luxury handbags. The corporation basically acted as the tax collector for the government.
So I paid the markup at the register, the company took my money, and paid the government. Now, the Supreme Court says that collection was illegal.
Right.
So the government has to give the money back. But and prick me if I'm wrong here, the government isn't mailing me a check for the extra $20 I spent on running shoes last year.
No, they absolutely are not. The refund goes to the entity that legally paid the government. It goes directly to the corporation.
This is wild. It's essentially a double dip for the companies. They collected the revenue from the price hikes, they kept that, and now they're getting their cost basis refunded by the Treasury.
That is the alpha insight here. It is a massive capital injection directly into the balance sheets of these major importers. We were talking about an estimated windfall of over $100 billion hitting the corporate sector.
$100 billion. That's not a rounding error. That is bigger than the market cap of most companies in the S&P 500.
It's massive. If you are analyzing stocks like Walmart, Target, or even the luxury conglomerates like LVMH, this is effectively a one-time earnings boost that just wasn't on the books yesterday.
Wow.
It's a direct transfer of wealth from the consumer and the taxpayer back to the corporate sector.
It sounds like an involuntary stimulus package for big retail.
It's a liquidity injection, pure and simple. And you have to remember, these companies were prepared for this. Over 1,800 lawsuits had already been filed by companies against the government regarding these specific tariffs.
They saw it coming.
Their legal teams have been waiting for this exact moment. They are going to collect, and they are going to collect fast.
So as an investor, I'm looking at this and thinking about capital allocation. What do these CEOs do with a sudden $100 billion windfall? Do they lower prices at the store to be nice?
History strongly suggests that is unlikely.
Yeah, I figured.
If you look at the 2017 tax cuts or the repatriation holiday, very little of that capital went to price reductions or even wage increases. The vast majority went to two places: dividends and stock buybacks.
Right, they shrink the float. So we could be looking at a massive wave of buybacks in the retail and import sectors over the next 2 quarters.
I would expect share repurchase authorizations to spike significantly. It improves their earnings per share metrics immediately. So for the consumer, the money is gone.
That's tough.
Prices might stabilize or come down slowly. Sticky inflation suggests prices rarely drop as fast as they rise. But the immediate winner here is the shareholder of these importing firms.
Which explains why we're seeing so much green on the screen for those sectors today, despite the broader political chaos. But I want to zoom out to the macro picture for a second. You mentioned the trade deficit earlier.
Right.
That was one of the main justifications for this whole experiment. The administration said we needed these tariffs to fix the trade imbalance. Now the experiment is over, can we check the scorecard? Did it actually work?
The data is actually quite damning on this front. It strongly contradicts the golden age of manufacturing narrative we often heard.
Let's hear the numbers.
If we look at the data for 2025, the U.S. trade deficit was $91 billion.
Okay, $91 billion. How does that compare to the pre-tariff era?
It's almost unchanged. The decrease was less than 1% compared to 2024.
Less than 1%. We upended global trade relations, spiked domestic inflation, and clogged up the federal courts for a movement of less than 1%.
It really highlights the inefficiency of the tool. The goal was to revitalize American manufacturing and bring supply chains home. But supply chains are complex beasts.
They don't just move overnight.
Exactly. They didn't necessarily return to the U.S. They just shifted to other low-cost jurisdictions like Vietnam, Mexico, or India to avoid the specific tariffs.
So it was just a giant game of musical chairs.
A very expensive game of musical chairs. And remember, other nations retaliated, which hurt U.S. exports. So the net position of the U.S. trade balance remained virtually the same. We paid a high premium for essentially no structural change.
And now we have to talk about the other side of the ledger, the government's checkbook. We talk a lot about the national debt on this deep dive.
It's the elephant in the room.
Always. I feel like we mention it every week because it just keeps hitting new highs. If the government has to refund $100 billion and they lose the future revenue stream from these tariffs, that has to blow a massive hole in the federal budget.
It's a severe negative signal for the fiscal outlook. And this is where the political narrative versus the mathematical reality gets really sharp.
Break down the numbers for us, because I know the administration was claiming they were actively reducing the deficit.
So let's compare fiscal year 2024 under President Biden and fiscal year 2025 under President Trump.
Yeah.
In 2024, the deficit was $1.83 trillion.
Okay.
In 2025, the headline deficit was $1.78 trillion.
So on paper, it went down. Not by much, but it did go down.
On paper, yes. However, and this is the key signal for investors, the 2025 number included the tax revenue from these exact tariffs.
No.
It was counting money, that the Supreme Court has now decided was illegally collected.
I see where you're going with this. If you strip out that illegal revenue.
Exactly. If you strip out the tariff money, the deficit under Trump for 2025 was actually greater than the deficit under Biden in 2024. The underlying structural deficit is widening, not shrinking.
That flips the script completely. So without the tariff cash propping up the numbers, we are spending more and borrowing more than before.
We are trending in the wrong direction. And look, it's not a partisan issue. It's a systemic one. Obama spent more than Bush, Trump spent more than Obama, Biden spent more than Trump, and now the second Trump term is trending to spend even more than Biden. The trend line is relentless.
And we are currently sitting at, what is the total debt number right now?
According to the U.S. Treasury, we are at $38.7 trillion.
$38.7 trillion. And we just lost an income stream of roughly $150 billion a year because of this ruling.
Correct. The government's projected revenue is now down by that $150 billion annually.
That's a huge hit.
When you combine falling revenue with rising spending, you naturally exacerbate the fiscal gap. This matters deeply for the bond market. If the Treasury has to issue more debt to cover these refunds and the lost revenue, that puts immediate upward pressure on yields.
Which acts as a gravity on equity valuations eventually. It's all connected. So what does this all mean for the immediate future? We have a massive hole in the budget, corporations getting a massive payday, and a trade policy that just got illegalized. The administration has to respond, right? They aren't just going to take this lying down.
No, certainly not. This is a defining policy pillar for them. We are expecting the president to address the public in a press briefing very shortly. Yes, likely today. And remember, the State of the Union address is next week.
Talk about a pivot. The speechwriters must be pulling an all-nighter right now.
It definitely changes the entire tone. This ruling has likely shredded the original draft of that speech. But investors need to watch for the pivot carefully. The expectation is that the administration will not abandon trade protectionism.
They're too committed to it.
Exactly.
Yep.
The ideology hasn't changed, just the legal avenue has been blocked.
So if they can't use the IEPA for sweeping global tariffs because the court basically said it was too broad and too much, what is Plan B?
Likely a shift toward targeted tariffs. The court's main objection was the sweeping nature, the total lack of specificity.
Right.
If the administration comes back with very specific, narrow tariffs on specific industries like steel, aluminum, or maybe semiconductors, that might actually survive legal scrutiny.
So instead of a blanket, they use a scalpel.
Or they might get creative with terminology.
There's a lot of speculation in Washington right now that they could implement fees on imported products rather than calling them tariffs. The classic, it's not a tax, it's a fee maneuver. We've seen that before.
It's a semantic game, definitely. But it might bypass the specific constraints of the IEPA or allow them to use different executive authorities. However, for the investor and the everyday consumer, the distinction is irrelevant.
Because it still costs money.
Whether you call it a tariff, a fee, or a border adjustment surcharge, it is an added cost at the border.
And that cost, as we've learned today, tends to roll right downhill to the person buying the goods at the store.
Precisely. The core investor warning here is that while the mechanism might change, the inflationary pressure of protectionist trade policy is likely to persist. We aren't returning to the era of free trade. We are just entering a phase of more complicated, legally maneuvered protectionism.
It sounds like we are moving from a blunt force phase to a guerrilla warfare phase regarding global trade.
That's a great analogy. And uncertainty usually breeds volatility in the markets. The market hates not knowing the rules of the game. And right now, the rules just got tossed completely out the window. We are in a vacuum until we hear the new policy approach.
So if I'm an investor, I'm watching the retailers for that short-term cash injection, but I'm keeping a very close eye on the long bond for the debt implications.
And you're watching the State of the Union for the policy response. It's a highly complex environment. The short-term sugar high for retail stocks is very real, but the long-term structural drag of debt and trade friction hasn't gone anywhere.
Many investors are thinking through what this means for their own positioning. If this raised a question or perspective for you, feel free to share it in the comments.
We always love reading those.
We really do. Before we sign off, let's quickly recap. We've covered a lot of ground today, from the Supreme Court down to the corporate balance sheet. Let's hit the key takeaways for someone watching their portfolio right now. First takeaway.
The Supreme Court has struck down roughly 70% of the administration's tariffs. The legal basis was that the International Emergency Economic Powers Act simply does not authorize such sweeping historic scope without Congress.
Okay. Takeaway 2 is the corporate windfall. This is a massive financial event for importers. Major retailers like Walmart, Costco, and the luxury brands are set to receive over $100 billion in refunds from the government.
But the consumers who paid the higher prices are unlikely to see that money returned. Expect a wave of stock buybacks instead.
Takeaway 3 looks at the macro side. The tariffs didn't actually fix the trade deficit. It remained completely flat at $91 billion in 2025.
And worse, the loss of this tariff revenue will widen the federal fiscal deficit, which is already hovering near $1.8 trillion. This is a clear negative signal for sovereign debt sustainability.
Which leads us to the final takeaway. Keep your eyes locked on the State of the Union next week. We expect new, likely targeted trade policies or alternative fees to replace the struck-down tariffs. The administration might be down, but they are certainly not out on this policy.
And as always, the debt clock just keeps ticking. $38.7 trillion doesn't care about Supreme Court rulings. It just grows.
A sobering thought to end on, but hey, that's exactly why we track the numbers and do these deep dives. We'll be watching that press briefing and the State of the Union closely to see what Plan B looks like. Thanks for listening to the 15-Minute Investor.